Welcome to another episode of Taking Stock for the week ending the 17th of April 2026. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin. Welcome back, Jason. Hope you had a good week.
Been a great weekend. Thanks for having me back again.
It's been a topsy-turvy week, but before we begin, just a reminder, the information we discuss today is general in nature and won't consider your personal situation. Well, Jace, markets have remained quite resilient despite a significant geopolitical shocks that's come through. But what's really driving that stability this week?
I think it's one of those classic repricing of risks, Kien, rather than actual improvement in any company fundamentals. I mean, markets are holding on to the possibility of a US-Iran ceasefire, and this has allowed oil to reduce and some of the risk premium that we've seen in the markets compress. Investors are effectively pricing out the worst case scenario, even though the underlying macro conditions are clearly deteriorating.
Yeah, I mean, when you look at the data, that deterioration is quite sharp. I mean, consumer sentiment that dropped 12.5% in April, and that was
Hmm.
the largest fall since COVID. Not surprisingly, with fuel costs rising so high, but also we saw global growth expectations. They've been in decline at the fastest pace in 4 years, while over two-thirds of fund managers are now positioning for stagflation. So that means slow growth and high inflation.
Yeah, typically over these type of periods, it has been quite challenging for equity markets. However, history has shown that markets are more resilient and have posted positive gains on average in the 12 months following any geopolitical shocks caused by oil prices.
Yeah, definitely, Jason. That's why it's so important here that we remain composed and stay
Hmm.
invested while also focusing on what you can control, and that is the management of those stocks in your portfolio and make sure you've got risk mitigations in place. But let's turn our attention now to some star stock highlights for the week, starting with Westpac. Now, banks are expected to report very soon, and Westpac's first quarter 26 trading update that pointed to a softening outlook, particularly with rising credit costs. What stood out to you here?
Well, the key signal coming from the bank, Kien, is a shift in terms of credit. The bank is now guiding to credit losses of around 10 basis points, which equates to roughly around 445 million, which is also about 150 million above consensus. Now, that reflects a weaker economic baseline and is increasing stress, particularly in fuel exposed sectors like those within transportation and also in agriculture.
Yeah, definitely. But operationally, though, the business still looks relatively stable. When you look behind the scenes, you can see that lending grew by 4%, deposits actually rose 3%, and then net interest margins that held steady, which suggests that the core franchise is still performing reasonably well in the current environment. And that's why these banks continue to trade at premiums.
Yeah, and also interestingly as well, Keen, costs are down around 2%, and this shows that technology investments and also productivity initiatives are starting to deliver. However, banks are inherently cyclical, so while margins are holding for now, the focus is shifting towards credit quality as the next phase of the cycle emerges. Fortunately, the unemployment rate held steady at 4.3% in March.
Yeah, quite a sticky unemployment rate there, but that means that that forward dividend yield currently at around 5.7% grossed up. That looks sustainable for now. Note that the bank goes ex-dividend next month. Now, keeping with the financials, turning to the investment platform provider, Netwealth, that third quarter update showed some resilience despite the fact that the market was very volatile in March. And the results seem to be broadly in line with expectations.
Yeah, the result was in line, and more importantly, it reinforced the quality of the platform. Net inflows over the period was of around $4 billion, which offset around 3.7 billion of negative market movements that we witnessed over the period. Funds under administration rose 21%, which was rather healthy, to just under 126 billion, which is a positive outcome for the company given the volatility that we have seen in equity markets.
Yeah, and that's the key, Jace. You've spoken about it because the stock is highly sensitive to market movements as well. Funds under administration, that was clearly impacted, but investors have largely looked through that.
Yeah, that's right. Because these flows are actually the real signals of earnings for this company. Market movements are cyclical, but inflows reflect advisor adoption and also market share gains. So the business is retaining guidance for net inflows to be broadly in line with those of last year, and the projected return on equity is above 70%, and this seems rather achievable.
Look, and with the share price trading well below its highs, the stock could represent opportunity for long-term investors who believe in the recovery of markets over the longer term. In Under the Microscope this week, let's go deeper now with infant milk formula provider A2 Milk. We've seen a downgrade in January, only for the stock to upgrade their earnings in February, and now there's a downgrade in April. What's driving this volatility in earnings expectations?
Yeah, there seems to be a bit of yo-yoing in terms of expectations, Kien, but the key issue right now is supply chain disruption and not demand. Fortunately, management stated that demand in China remains rather strong, but transportation delays, product constraints at Sinolay, stricter regulatory testing, and also slower customs clearance have limited product availability, particularly for those China labeled formula.
Yeah, and that's definitely reflected in the updated guidance, which has been reset lower, with the earnings now coming below consensus by around 10%.
So the surprising part is revenue growth has been cut to low to mid double digits, and margins have also reduced to around 14%. Earnings is now expected to be flat to down on FY25.
But what I notice as well in terms of the outlook for this year is that return on equity is now expected to fall below our 14% threshold this financial year, meaning that it may not be a star stock for too long.
Yeah, from an earnings efficiency perspective, that does mar performance somewhat in FY26. But combined with some of the repeated guidance changes that we have witnessed over the last 12 months, it raises questions about management's ability to forecast earnings and also forecast revenue. Even if the issues are temporary, which it seems like it is, investors tend to discount businesses more heavily, especially when visibility becomes a lot more inconsistent.
Yeah, certainly a risk to watch there. But apart from the supply chain risks, the company is also facing obvious structural risks as well, such as slowing Chinese birth rates.
Yeah, that was the key concern prior to the company's upgrade a couple of months ago. But the A2 Milk Company has been able to offset some of these structural risks through premiumization, execution, and also market share gains. Additionally, their latest acquisition, which is into the Pekino assets, is expected to deliver significant strategic benefits in this context. It also enhances control of the company's China label registrations and also reduce reliance on other third-party manufacturers like Sinolay.
Yeah, making it more vertically integrated there. But so what should investors focus on from here with A2 Milk?
Yeah, and I think that's the key question. Investors need to be rather patient with this one because it is dependent on supply chain normalization. Investors who are not comfortable with this could either swap out into other potential star stocks within the universe that may have also fallen significantly and take advantage of some of the mean reversion that were expected, given the fact that a lot of earnings from most companies are still highly visible.
And now for question of the week. A pertinent question for members right now is which sectors and star stocks are most vulnerable to the economic challenges that could occur following the Middle East conflict?
Yeah, this is a pretty interesting question, Ken, and I think the real answer is it impacts every sector of the global economy. The most obvious areas that most people tend to zone in on right now is transportation. Fuel costs flow directly into margins. And for example, if airliners like Qantas, the company came out and they're sort of expecting an $800 million headline in terms of fuel costs, which could lead to 18% downgrades this period.
That's right. And building materials as well. They are also quite vulnerable, particularly through inflationary costs of materials, together with the interest rate response to higher inflation, which could dampen demand.
Fortunately, we don't have any exposures to the transportation and building materials sectors. However, there are obviously second degree impacts at the consumer level. Retail stocks are potentially vulnerable as consumers tighten those purse strings, and this could pose a bit of a headwind for discretionary names like Nick Scali, Super Retail, and also potentially Universal Store.
Yeah, and within that industrial space as well, there are names like, for instance, Brambles, which are dependent on global supply chains, also supply networks delivering commercial truck parts, and Redox, that global distributor of commodities such as chemicals. These are vulnerable to current conditions.
Also, as well, we have the resource sector, which is a little bit more nuanced, but nonetheless still exposed through multiple channels. Miners face diesel costs and also potentially softer demand from China. And also with gold equities, these companies are dealing with rising energy costs, which accounts for roughly of 20% of their all-in sustaining costs.
Yeah, it seems quite high there, Jace, but fortunately the gold price is quite elevated, so it's actually helping them at least maintain some of those margins. And yes, risks are elevated across the sectors and stocks heading into this next reporting season. So it's important you diversify and limit your exposures accordingly. But that brings us to the end of this week's episode of Taking Stock. Thanks for your insights again, Jace.
Yeah, it's always a pleasure to be on, Kien. And for those viewers, thank you so much for joining us. If you have any friends or family who might benefit from Stock Doctor, please feel free to send them a referral.
Until next time, have a happy, healthy, and prosperous week ahead.